Nicolas, thank you for the introduction earlier. I'm Rob Lustrin. I'm a partner in Seward and Kissel's Capital Markets Group. It's great to be back in Athens with everyone today, friends, clients. It's always a good time. Thank you. For those of you who aren't familiar with our firm, we've been around for well more than a century and have been working with our many clients here in Greece for decades, helping with capital markets transactions, restructurings, and so many other types of deals. So first, some general observations, and then we'll get to the meat of the panel. There really is a high level of excitement in the United States today in and around the capital markets. Aside from the volatility over the last few days and the last few trading sessions, the securities markets have been up very heavily, and I think that we all expect that this will lead to a renewal in interest in shipping as the velocity of international trade begins to get more vibrant across the markets. New issue equity offerings remain limited. There's not a lot of IPO activity. The focus still is on technology companies, and some of the some of the metrics around shipping companies haven't really caught up yet. So there may be some opportunity there. Much like we discussed last year here at this conference, for shipping companies, deals are getting done, but more on a one-off, one-at-a-time basis, rather than the more vibrant pace that we saw back between 2007 and even after the financial crisis began. I think through 2010 we really saw some activity going on. That being said, the mood on Wall Street, as I said earlier, seems much more positive than where we were when we sat here last year. Money for capital raising transactions is available, with investors looking for value in this high market. As for the various shipping sectors, just some quick observations. Tanker companies seem to be facing some muted demand from where we sit, and there is little interest in oil services, platform services, and things like that. That's continuing with what's been going on in the offshore industries, still remaining distressed. The bright spots appear to be in more specialty areas such as LNG. And in the U.S. capital markets, consolidation, and we heard a lot about consolidation earlier and in the various panels. Consolidation among shipping companies is continuing, such as the recently announced, well, not so recently, but the announced Euronav and Generate merger. And reportedly, consolidation is occurring pretty rapidly in container shipping, primarily in Asia. Dry bulk was a bit ahead of the consolidation curve, having had some pretty substantial merger activity a couple of years back, and seems stable with a very hopeful outlook. And ostensibly having turned a corner, let's see if we can light the fire of the capital markets around that. Of course, mine are just observations, so let's hear from this wonderful panel that we have here, the investment bankers. Once again, we have a terrific panel of bankers for you, all of who are very active today in the capital markets transactions, both in the U.S. and abroad. So we have with us, and I guess I'll go down that way, Erik Schless, Managing Director of Wells Fargo Securities in its Industrials Investment Banking Group, which includes shipping. To his immediate right, Todd Wilson, Managing Director of Maritime Investment Banking at Jefferies, which has been a great friend to the shipping industry, and some of the first IPO activities Jefferies was a part of, including the Stelmar transaction going way back. Next is Nicolas Duran, a Director of Corporate Finance and a partner at Fearnley Securities, again, a company with very rich history in shipping. And to my immediate left, Christa Volpicelli, Managing Director in the Global Transportation Group at Citi, and she is also the leader at Citi's U.S. investment banking team for shipping. So if this group doesn't know what's going on in the capital markets, nobody does. This is a terrific group. So let's just start off. Maybe I'll start with Erik since he's at the end. I'd like to focus on what's happening in the U.S. capital markets, primarily on the general state of the markets. And the age-old question, is the market open to shipping companies?
Well, I suppose you can't really talk about the state of the markets without talking about the last few days and how to put it into perspective. And I think that what I would say is that when you look at the absolute numbers of how many points the Dow dropped or the S&P or something of that nature, it looks pretty dire. When you start matching it up to the percentage drops, it's nowhere near as bad as it looks. And so that I think that for many people, this is, the market had gotten ahead of itself since the first of the year. This is a bit of a way to address that, getting ahead of itself. Interest rates are probably likely to move up, but I think they're moving up because economic activity is up. In fact, remember that a lot of the sell-off was triggered by the fact that wages are up. And if wages are up, people are making more money, they can buy more things. That's probably not so bad from a fundamental standpoint. Does it put a little bit of pressure on interest rates? It certainly could, but I would contend that it's probably better to have pressure put on interest rates by people making more money than by a wholesale exit of the central banks from their principal positions without any supporting economic growth. So that I think that in terms of the state of the overall markets, our view at Wells Fargo is that nobody likes this sort of experience over the last week or 10 days, but it's certainly not the end of the world. Now, as to the shipping markets, it is interesting to note that in the last 12 months, and I've got a bunch of slides here, if people want to get copies of them, I can get your cards later, but really the only sector of shipping that has even close to kept up with the rise of the S&P over the last 12 months is dry bulk. Everything else, including LNG, which is, seems to be everybody's kind of poster child these days, has not kept up. And so that to what extent, what is going to cause people to invest in asset classes that have underperformed over the last period of time? And I think that obviously it's the prospect of the future. And as we look at that, you can go sort of sector by sector, but I think that the markets will open, but they have to be for very liquid stocks that people can get in and out of very quickly, and for companies where the growth path is visible and achievable. So I think those are the elements that have to be in place: size and visibility and credibility of growth.
Thank you, Erik. Todd, do you have any thoughts on general state of the market?
Sure. I think Erik's points were spot on. I think investors were looking for any excuse to sell for the broader markets. People were playing with house money at that point, so any excuse to sell, put your money away in something more safe. I think that's part of what we've seen, and I think it's temporary. I think to Erik's point, there's still a lot of positives in the economy, and inflation could be good. Higher interest rates could be good if it's driven by people making more money and a synchronized global expansion, and it could be great for shipping, right? So the way I've thought about the broader markets in the past month is people are waiting for an excuse to buy shipping stocks, and I think if we start seeing some inflation, we start seeing some of the earnings supported by what we all think, I think, is a favorable supply-demand dynamics almost across sectors. I think the windows could open a little faster than maybe I would have said 6 months ago.
Maybe Christa can, maybe you want to go next, and then we can.
Yeah, absolutely.
Circle back.
I guess I agree with what my colleagues have said up here, and I guess I would add a couple of things. I think that when you look at the fundamentals in the underlying market, corporate earnings are still going up. And 50% of the S&P have reported their fourth quarter earnings. 77% of them have beaten consensus estimates for what they are. The general outlook as we look at 2018 is that EPS is rising across the street. This is outside of shipping, but in the broader market. And so that underpinning is essentially what is the key driver of the market today. People talk about the market overall being at high levels relative to history, just on a price to earnings basis in terms of relative valuation levels. I think that that presents an interesting opportunity for investors in shipping, because in that kind of environment, investors start to look at cyclical sectors as a way to earn outsized returns. So that should benefit shipping in our view. The other comment that I would add is, Erik made the comment that dry bulk over the last 12 months is the only sector that kept up with the S&P. I think one of the interesting dynamics in shipping today is if you actually go back over a longer period and you start at the beginning of 2015 and you look across the different sectors of shipping and where their equity values are today relative to early 2015, every single sector is down below and has lost a lot of equity value since that period of time, despite the S&P being up 30%. And so that today presents a very interesting opportunity for a new investor coming in. Now, from the perspectives of the companies who are listed, there's a cost of capital consideration in terms of do they want to be issuing equity at these levels. But I think that ultimately it all comes down to the fundamentals of each sector and what the outlook is. But we feel good about the potential of many sectors today, and I think to Erik's point, investors are really just looking for the right combination of company capital structure size to deploy their capital.
Thanks, Christa. Nick, question for you. You can, I think, expand on what we've been speaking about in the U.S. capital markets, and maybe coming from Fearnley's, you might have a good perspective to segue into the international markets, particularly what's going on in Norway. If you have a handle on that, perhaps that would be helpful.
Thank you. I would say that maybe even more so than in the US, the capital markets for shipping in Oslo has been very open. We've seen a lot of activity there over the last 18 months. I would say that in many ways, a lot of the extremely value-oriented investors came in at a very early stage of the recovery in both dry cargo and containers. What we've also seen, which is a view that Fearnley has as a house, is that I think now it looks like we're going into sort of synchronized recovery of all the shipping segments. Of course, dry cargo has come further into the recovery than containers, but both of those are well on their way. LNG is looking positive. We believe we'll turn the corner on tankers and LPG this year. So we think that from our conversations with investors globally, we believe that there's a very healthy appetite for shipping. In Oslo in particular, I think one of the reasons why we've seen a lot of deals there is because the hurdle to make a move in the Oslo market, either through an OTC or a mercury listing, as have been several examples of in the last 18 months, is so much lower than doing an IPO in the US, for example. So we've seen that people have come to us keen to move quickly. Obviously, doing an OTC or a mercury listing in Oslo is substantially cheaper and more cost efficient than doing the same type of exercise in the US through an IPO. And so we just think that's one of the reasons why there's been more activity there.
Thanks, Nick. Now, just thinking about the recent consolidation that's gone on in the shipping industry, we've heard in the past bankers saying that, look, you really need to have a certain amount of size in order to get attention in the capital markets. Of course, there was a time where, I know, a 5 or 6 vessel fleet, with a good basis of charter cover, could, as a use of proceeds, do an IPO and double, triple the size of the fleet, and do something that was far less than that magic number, whatever it is, $500 million and up, or whatever the number is today. I was just wondering whether the consolidation is a good thing or a bad thing from your point of view as investment bankers, and whether you'd like to see more before you think that shipping companies will be able to, fully access the capital markets, or do the markets really just have to catch up to where we are? That's kind of my question.
Rob, I'll take a crack at that. I think that the reason that consolidation is good certainly from the public market standpoint, is that people who buy into a company that is either already public or going public think about growth, and they think about the growth of their investment. And so the possibility, the likelihood of M&A activity, whether as an acquirer or as an acquired entity, is an important element of that. And if you take that away from somebody's view of a stock, then it is just pure organic growth that is going to get them there. And I think that when you look at an industry like shipping, which when you think of other transportation modes and how consolidation has occurred in those modes, that can be a very powerful force for shipping. So I would say that consolidation is good for the equity markets in shipping, and I think that the increased consolidation that we've seen in the past, in the recent past, hopefully will continue because they have been done with industrial logic. And it's an opportunity, again, for what we talked about earlier, size, liquidity, growth. Those are all three themes, and consolidation helps all of those.
I mean, I agree. Of course, consolidation is good for investment bankers, but I think it's good for the market as well. And I think what we've seen in shipping over the last several years is some companies stuck in a rut and not being able to trade above asset value. And a lot of that is driven by the factors Erik mentioned, which is size, liquidity, governance, transparency. And so when you start seeing mergers, right, I think so all of them are done for different reasons, and private into public can be an exit strategy for a PE firm, but a public-to-public merger, to me, that they're all about providing a more investable company for investors. And what do I mean by that? I mean bigger, obviously, and larger float, and something that hopefully doesn't have a massive overhang on it, right? So a big sponsor owning half the company that's looking to sell. And so I really think one of the biggest hurdles for investors right now investing in shipping, because there is value out there, as Christa mentioned, is are they investable, right? Can I invest my money in and get it out? Are they transparent? Are they governed well? Is there no overhang in the stock, right? So I think these corporate mergers are going to help to dilute some of these big stakes that some of these sponsors have, as well as, you add two companies together, each company has a float, it doubles the float, right? So I think it makes better companies for the capital markets, puts hopefully a little more attention on shipping, and gets investors caring more about shipping investments.
Go ahead, Christa.
Okay. I would add that I fully agree. I think consolidation is very good for the publicly listed companies. I think it's a trend that we're seeing in shipping as financial sources have become more constrained over the years, whether that's debt capital or equity capital. Having scale helps on either side of the equation. But I also think when we're advising companies on mergers, which is half of what we do as an investment banker, it's not just about getting bigger for getting bigger. It's, what do the two companies, what can they do together? And, one of the challenges in shipping is that in a fragmented sector, you may not have as many industrial synergies to combining, because you may be able to run a fleet very efficiently if you have very good insights into the market. That said, I think certainly we have seen companies benefit from cost synergies in terms of being able to manage a larger fleet across a similar set of resources, and commercial synergies, much of which can be achieved through ways such as pooling, and many companies have done that successfully. But you've seen it happen in the liner industry. And I do think, you're seeing a start to it in the tanker industry, and our view is that it will continue.
I think that one very important point which Christa raised is, and one of the reasons why we think we'll see more consolidation going forward, not only amongst the public, but also with some of the private companies, is that the decreasing access to debt for both private and smaller public ship owners is becoming a big problem, or a bigger problem. And only by having liquidity and scale can you have the optimal access to debt capital, whether it's through bonds or debt from the traditional lenders. And we think we're going to see more of that going forward, which is, the evidence is in the growth of the growth in alternative finance. Private owners that are struggling to get to raise debt from traditional lenders, and are instead looking to hybrid capital. That's just evidence of what's to come, we believe.
Okay, thank you. I'm thinking about what's the best way to go public. We have many folks in the room here who may have a family fleet. They may have an extensive fleet. They may have a smaller fleet. I mean, obviously, a one or two vessel situation might not be the ideal candidate to bring public. Perhaps maybe that's a good candidate for more of a, get gobbled up or something like that. But just in terms of someone that may have a substantial family fleet and wants to start thinking about what they need to do to prepare to do an IPO and how to structure that, what would your recommendations be? And I don't know who'd like to pick that up and start. Nick?
Yeah, I think one thing which is very important today, given that you have a lot of fairly large, good shipping companies that are most of the time trading below NAV, if you're going to go to the market and list your fleet, you need to differentiate yourself from what's already out there. Either that, or you're going to get hit on pricing, and you need to offer a substantial discount to what's already out there. So we think that presenting a story which is different from what's already available is key to doing that. And we've seen that the IPO market in the U.S. has been fairly closed to shipping, whereas things like the NOTC and also have been extremely open. I mean, Borr Drilling raised close to $2 billion in the space of 6-7 months in an OTC unregulated platform. And I think that just tells you something about how going forward we'll probably see more people to attempt to go that route rather than the traditional US IPO.
Well, I grant you that's been going on for a little bit, but maybe we have an alternative view.
So I think it's important to think about why you're going public. And if you're going public because you really believe that you've got a growth opportunity that is only going to be fulfilled by exterior capital, then that starts you down a certain path. And you heard some private equity people earlier. Going public is part of that process. And if you have a large fleet, if you can achieve the liquidity that in your stock that we've talked about, and you have a plan that says, a very understandable and achievable plan that says, here's how we're going to grow, that's a great IPO story. What is a more challenging IPO story is, well, we're kind of going to do what the market does, and we want to view this as a way of mitigating the risk that we as owners have in this platform. That is more challenging. That's when you fall into a more undifferentiated bucket, I would say.
Yeah, but I guess my question really is it a fait accompli that you have to get that private money in first and grow to a certain level in order to get there? Or, if you have that story and you have, whatever the growth story is that marketable today? And if not today, what's our expectation? I mean, I would think that the expectation is that there will come a point in time when that will be something very viable and attractive.
Well, I'll just throw out my opinion because this is pure speculation, but the market has become more and more if you go back 20 years, there was such a thing as a $50 million IPO, and people said that's just fine. The market is not there anymore. It's the domination of large institutions, which the large institutions 20 years ago are multiples of the size that they were. So I think that if you have a family company and if your fleet is of a size that you can address that, that's fine. But I think that my personal view is that the 4 or 5 ship fleet with a great vision of how to exploit the market is still going to have a tough time getting it done. It's got to be, I agree with Nicolas 100% that differentiation is important, but I think you have to be realistic and say 4 or 5 vessels, at least in my opinion, Rob, for the foreseeable future, that's not going to work. Now, others may have other views, but
Yeah, Christa, you
I
were-
would add that I think, I agree with Erik's views, and I think it's also, Erik was talking about the path of asking yourself, why are you going public, and what is this doing for the company? I think we absolutely think as much about, what are you doing day one for the IPO, how will you be valued, how will you be differentiated from the other opportunities that are out there, because it's ultimately a relative valuation exercise. But ultimately, your IPO is setting the stage for your success or lack of success as a public company. So it does no good. You can go prepare to go public, and there may be a window, and it might be just the perfect point in time where stars have aligned, the sector backdrop is strong, and you get something public. But if you get something public in a window that's opportunistic and it's not set up for the long-term success, whether that's capital structure, whether that's size, over the long term, the valuation of that company will reflect it. And if you have a stock that is going to consistently trade at a discount to NAV because it's smaller than the rest or doesn't benchmark as favorably, then what good is it being public because you don't have efficient access to that capital going forward? So in our minds, it's, what does the IPO look like? But what do we think that this company looks like once it is public, and will this be an efficient source of capital for the company and its investors going forward? And that's a dynamic discussion that we all have with companies as we're assessing this prospect.
Todd, maybe you can have some thoughts on that, and also you can maybe address the growth versus yield aspect of it as well.
I'll touch on that secondarily, but the one thing we haven't talked about yet, as far as, if you're a family and you're considering going public, you have to get a read on the investors, right? So right now, investors that have invested in a shipping IPO in the last 5 years have not made money. And so until you see someone making money in their shipping investments, and now dry bulk is up over the last 12 months, right? So if you timed it perfectly, you made money in the dry bulk sector, and there are other points. I'm not saying nobody has made money investing in shipping, but in the IPO space, nobody has made money investing in shipping in a while, unless, again, they timed it absolutely perfectly. So you have to consider, no matter how differentiated you are, if investors are not making money in their shipping investments, it's still not a good time to go public, right? You're still going to be dragged down by the overall shipping sector. And so I think you have to see some momentum in earnings, some momentum in the stocks, and unfortunately, I think it goes across sectors, right? So even if you have the best product tanker company in the world, if the 2 or 3 companies that have exposure to product tankers in the public space are still trading at a discount, you're going to be in trouble. And so I think you have to take into account what investors want at what point in time as well. As far as growth versus yield, the yield companies, other than maybe some of the LNG right now, and even some of those are trading at very high yields, making it very hard for them to acquire assets, and they have too high a cost of capital to make accretive acquisitions at this point in time. So I'm not sure the yield story is the one investors want right this second. I frankly think investors want to see if there was a company to go public, and if the comps weren't trading at discounts, I think it would be something that has some volatility in it, is a real company, again, investable, clear governance, no conflicts, and growth either through acquiring accretive assets, or because it's a volatile assets class and the supply demand dynamics look good, and there's some real upside in the price. I don't think a yield play right now, it would be priced against the other yield plays, would make sense from a cost of capital perspective.
Thank you, Todd. Just switch gears again. I'd be interested in knowing what each of you feel about the types of transactions for your public company clients that you work with. Do you feel that convertibles are really still very strong in the secondary, in the secondary markets as they're trading? Is that the type of instrument that you might recommend to an existing public company, of course, if all of the metrics are correct for that? Or do you think that more straight capital markets debt might start to creep in here? We haven't seen really a lot of straight, either high yield debt or straight corporate type debt creep into the playbook in a while. I'm wondering whether we're getting to the point in the cycle where that might make some sense.
Yeah, I'd like to comment on that. I think we're seeing tremendous interest in shipping bonds. Traditionally, bonds have not been a much explored or used form of funding for shipping companies, but we see a lot of investor appetite. Of course, a lot of those bonds, both secured and unsecured, are trying to fill the gap or vacuum that's being left by the banks that are trying to reduce their exposure. And we definitely think that that type of capital is going to play an extremely important role for the listed companies going forward. And we've already started seeing the deals being done, and the appetite has been very strong.
Thanks. Todd, your high yield guy's getting itchy?
Look, I think there's more investor demand for high yield paper in the shipping sector than there is supply. And I think that's primarily, owners have options, right? Oslo is an option. You have to be of a certain size to access the U.S. high yield market. And frankly, I think owners aren't ready to pay the prices and live up to the covenants, get a rating, which may affect their bank relationships. So I think there are some factors that limit some of the ship owners that will access the high yield markets. But from an investor perspective, in the high yield space right now, yields are at all-time lows. Deals fly off the table, right? It's a very issuer-friendly market, and I think shipping would provide a way to play yield, right? A risk-return yield, but there aren't, hundreds of shipping companies that would even have the right profile to access the high-yield markets. So I think, again, I think you would see more. I think there's more investor demand than there is supply. So I think it's very open for shipping market for a shipping company, but it has to be the right kind of company.
Rob, can I just make a comment there, please?
Please.
So I think that one of the things that Todd's right. I mean, if you just look at the high yield market as a one-shot deal, it is the sort of look through by banks as to, gee, I was charging you this for this money that I lent you, and you went to the high yield market and it was this much more. There's a risk there, right? But I think that particularly for larger companies, the high yield market is a slice of capital that should be considered, maybe not necessarily endorsed, but should be considered as part of a long-term strategy. So if you're just going to do one high yield deal and say that's the end of it, I think you go through a lot of pain and suffering to do that one deal. The attraction of the high yield market is once you've done one, it's very easy to go back thereafter, and it's a lot easier than going public, but it's not unlike that once you break through that initial piece, it can be a very helpful and dynamic part of your capital structure, particularly getting back to an earlier question that you had, Rob, particularly if acquisitions, substantial acquisitions are going to be part of your ongoing strategy. So I think that one thing that we didn't talk about, the term loan B market is very active, and one that I think that shipping companies should be thinking about. The convertible market, the shipping companies have had some challenges in the convertible market just because of the lack of borrow in the stock. And so it makes it a little more challenging. That's kind of a technical issue. But I do think that all of these forms of capital need to be thought about on a long-term basis and not just as a one-shot deal.
Christa, perhaps you want to speak a little bit about what folks at Citi are doing and your expectations as to what you think we'll be seeing. Are convertibles still something that looks like it's going to be a way to get at the equity, so to speak, or do you see more debt creeping in at this point? Straight debt.
I think the good news is right now, all of these markets are very strong. And I think it's an issue of what's suitable for the company and the company's size. I mean, we just were involved placing a convertible bond for TK Corporation up at the parent level, which they were able to upsize and price within the ranges that they were targeting. And it will serve a good purpose in terms of what they're utilizing the capital for, which is a refinancing event. So I think the convertible markets are strong, but to Erik's point, not every shipping company has a big enough size, right? We talked about size earlier. You have to be a big enough public company to be able to access the convertible bond markets or the high yield bond markets or the term loan B markets efficiently. But I think you will see a trend as companies get larger. Utilizing these markets will help companies diversify their access to capital, which again just goes back to some of the earlier comments in terms of size and scale. But right now, all markets are open.
And one final question, which just comes to mind. We've heard a lot today about technology and changing technology systems, utilizing some financial technology and trying to superimpose that on shipping, things like data utilization and the like. I'm just wondering whether technology, seeing that, especially from a retail investor point of view, it's kind of something that people look for now, being on the cutting edge. Is that something that is a necessary element when accessing the capital markets, to say that you're on top of the latest shipping technology, or do people really see through that and they're just looking more at the risk and return metric?
I think technology enters into it when there's a level of accountability, so that are you able to anticipate what your business is doing? How are you able to do that? That's how technology enters into it. And I think that, but I think and the other way technology should enter into it is you should be more profitable. I mean, that's the whole premise of technology. I think that when all is said and done, people really care about the vision, the growth, the plan. People want to hear about an IT system. I don't hear people ask about the technology system in a shipping company the way I hear them ask about the technology in a logistics company, for example. So I would say that one of the positive things out of all this is that growth, margins, return, that's really, when all is said and done, that is where the equity investors' focus is going to be. And to the extent that you have some special technology that enables that, that becomes even better, because to Nicolas's earlier point, it becomes a differentiator.
Well, we're getting close to the end of our allotted time slot, so if anyone has any questions, I think this would be an opportune time to open it up. And while we have this fine panel sitting here, if anyone has any questions.
I have one question. I hope Mr. Laskarides will forgive me for asking it. Oh, please. Because we're going to the next dynamite panel. That's for Nicolas. And the question is the following. If most of the money that has been invested in the OTC market in Norway comes from the United States. So my question is, why would American investors decide to invest in an OTC listing that is illiquid and not support an IPO in the U.S. that would be highly liquid and highly tradable right away?
That's a very good question. I think you need to look at the composition of the investors that have been active in the deals that have been done in the Norwegian OTC. Of course, we've seen primarily a lot of the smaller to medium-sized hedge funds. We've seen a lot of family offices and high net worth professional shipping investors. I think all of those, what they have in common is they see that, the asset play opportunities that have come to the Norwegian and OTC market have never been part of the sort of US IPO domain, because it's too costly and your time to market is too long to be able to do that in the US, in our opinion. And so we think that, if you take an example like Songebulk, which was done in 2016, if I'm not mistaken, the first equity raise, everyone had seen the dry cargo rates just start to recover, and investors were kind of asking, how do we put money to work in a vehicle with clean sheets that has no legacy issues? And I think the Norwegian NOTC platform was a perfect catalyst or enabler for that.
Speed of execution.
Exactly.
Thank you.
My question is also directed to Nicolas, and it relates to the NOTC. We've worked with several of our clients, which were Greek shipping companies, smaller companies, and they gradually raised 2 or 3 times equity on the NOTC, and then they listed New York or NASDAQ. The question is, I fully agree that a 5-vessel company would not be appropriate for an IPO in the States, but we've seen 5-vessel companies grow and thrive on an NOTC offering with several follow-on offerings. Within the next, let's say, 6 or 12 months, would there be a particular field of shipping sector that you would see might be the appetite of the type of investors you solicit would actually like? I mean, you mentioned about differentiating yourself, but it's not quite clear. And maybe being a bit more specific, what would be, in 3 bullet points, what you would want to see in a Greek shipping company, whether family or not, that would be a good candidate for an NOTC listing?
Well, as one of the previous panelists pointed out, I think there's a lot of expertise, operational expertise in the Greek shipping community. That's one important thing that I think investors would look for in a company. Secondly, I think in terms of differentiation, if you look at the list of listed companies, you look at who has succeeded with on raising money on the NOTC in the last 18 months, there are a lot of companies that are coming to the market that don't have a natural peer. So for example, MPC, you didn't really have any feeder specialist container ship companies that were listed and that had 0 legacy issues. A lot of the listed container companies were either in larger segments or had a very mixed fleet. So I think keeping that in mind, something in the LPG space, which is not VLGC, because there's plenty of peers there, or comparables there. Maybe looking at something in the chemical tanker market. Of course, you have Stolt and Nodfield, but that they kind of live their own life in a way. So there's plenty of other room to maneuver in the chemical space. So I'd probably say those 2 off the top of my mind.
We have some more hands back here. Well, it's up to you, Nick.
Well, the cost is I mean, it's almost immaterial compared to a US IPO, but you have to keep in mind that being on the NOTC in Norway cannot be a permanent solution. It's a stepping stone to something else, and as you evolve into a full listing in Oslo or a full listing in the US, the costs will follow. So you need to have a plan of how to unless you're planning to get big at some stage, there's no point in even doing the OTC because, as Christa pointed out earlier on, being public just for being public, if you don't have the scale and the liquidity so that you get the pricing, it's not a tool that you need or can use.
Thank you very much for listening. Oh, we have one more quick question. Well, does anyone feel the U.S. capital markets can assist the Greeks in building national pride?
Well, I guess I would say, to Nicolas's credit at Capital Link, I think Capital Link has done a very good job at bringing Greek shipping companies to the international investor community through events like this and events in New York. And, if you look across the number of companies that are listed, quite a few of them are based here in Greece. So I would say that Greek shipping companies are already a very important part of the international investor base.
Thank you all. Thank you.